Assalamualaikum and hi, we are from Group 12. The topic that we will present is risk in Treasury operation. This is our group members. This is our subtopic that we will present shortly. So, let's start it.
Assalamualaikum and hi, my name is Nur Zulaika binti Muhammad Ali Yusof, number matric 255889. I will present about counterparty risk. First, I will present about the counterparty risk. What is counterparty risk? Counterparty risk is the likelihood or probability that one of those involved in a transaction might default on its contractual obligation. Counterparty risk can exist in credit, investment, and trading transactions. Counterparty risk is also known as default risk. Default risk is the chance that companies or individuals will be able to make the required payment on their debt obligation. Lenders and investors are exposed to default risk in virtually all forms of credit extension. Counterparty risk is a risk that both parties should consider when evaluating a contract. Next, I will present about the comparison between counterparty risk and credit risk. First, in terms of meaning, counterparty risk is an inability or failure to make a payment. However, the amount of exposure is not predetermined, while credit risk, a possibility of loss on account of default due to the inability or unwillingness of a borrower to meet its liability, so the amount of loss is predetermined. Second, in terms of scope, counterparty risk is most relevant in derivative markets, especially in OTC trades, while credit risk is relevant in loans and advances given by banks and financial institutions. Then, in terms of subset, counterparty risk is a subset of credit risk, while credit risk includes counterparty risk as well. Then, in terms of exposure, counterparty risk is a risk exposure of account varies based on the MTM position on the date of default, while credit risk exposure is mostly predetermined and does not vary. Lastly, I will explain about how to mitigate counterparty risk. There are 7 strategies adapted by the banks to mitigate counterparty risk. First, it is hedging. The risk management strategies adapted by the banks in making an investment into eliminate or reduce the risk of adverse price movement in financial instruments such as bonds, notes and shares, foreign exchange derivative or precious metals. Second, trading with selected counterparties. Banks trade only with counterparties with excellent credit quality. In this way, risk is mitigated as their default is highly improbable in spite of potentially very large exposure. Third, close-out netting, a very standard risk mitigation method for counterparty risk practiced worldwide. Netting allows amount owed to a counterparty to be offset with those owed by the other counterparty. Fourth, collateralized transactions. A further way to reduce credit exposure is through the use of eligible financial collateral for the transaction. Only cash, deposit, LIC surrender value, and gold are accepted as eligible collateral security. Fifth, pro-rate sharing of security. This will help a bank to share the risk amongst the other member banks. A letter in this regard will be obtained from the leader bank. Sixth, guarantees as a credit protection. Taking of suitable personnel as well corporate guarantee is another method of mitigating the risk. And lastly, capital conservation buffer. It is to safeguard that banks ought to build up capital buffers during normal times, which can be utilized during stressed period to wipe out the losses incurred.
Hello, my name is Treasury binti Manasih, number matric 264703. Okay, now I will talk about operational risk. So what is operational risk? Operational risk is actually a methodology for organization looking to put into place oversight and activity when it comes to managing risk. And it is also can be the chance and uncertainty that the company has to face while they are conducting their daily business activities, a system and procedures. Now I I will talk about the benefit of operational risk. So, by managing the operational risk, it can help to convince those with the sign off on the decision that it is the right move for the company organisation to do this. So, the benefit is we can improving the reliability of the business operation. We can also improving the effectiveness of the risk management operation. Besides that, we can also strengthening the decision making process where risks are involved, and it can also cause a reduction in the loss caused by the poorly identified risks, since there are already early identification of unlawful activities. Hence, it can lower compliance costs, and there's some reduction in the potential damage from future risks. And besides that, it is actually a lot of benefit as well as a few of challenge that the company will face while managing the operational risk. So, however, operational risk management is actually a step for every company that is wants to avoid for the potential damage issue in their company. So it is important for them to manage this risk. Okay, now I will talk about the impact of operational risk. So there are three primary areas that affect with the business activities. First is property exposure, which relate to the physical asset belonging to or entrusted to the business. And second, personal exposure, which relate to the risk faced by all those who works for and with the business, including customers, suppliers, and contractors. And third, financial exposure, which related to the all aspect of the company abilities to trade, whether profitability or not, and cover internal and external exposure of all types. Besides that, the financial exposure also will include intellectual properties, goodwill, and patent. Now I will talk about the example of operational risk. For first is environmental risk. So environmental risk is actually the risk that related to the natural environment that could result in damage to the building, restriction to the access to material, or loss of human capital. For example, it's affect with the weather conditions such as fire, flood, environmental pollution, and others. And second is financial risk, which is related to the credit, interest rate, the stock market, currency, and collateral. For example, foreign exchange risk rate. Third is business continuity risk, which related to the condition that could result in the work stoppage or adversely affect with the production, delivery, marketing, suppliers, and others. Since the example is the reliability within the supplier's chain, supplier integrity, quality of good, price of external supply. And fourth is innovation risk, which related to the transformation of some aspect of the business in an effort to improve the operating performance. For example, the company will undergo the performance in the new product development and in research development and R&D investment. And fifth is commercial risk. This risk is related to the expected performance of product or service. For example, the of the engineering, marketing, communication, sales, and others. Six is project risk, which related to the completion of a project. For example, there will exist some technical difficulties, commercial obstacles, and others. Seven is human resource risk, which related to the adequacy and execution of human resource standard, policy, and practice. The example is there will have ethical or unethical conduct by the management and employees, and the availability of assistance to employees for the career planning and personal development or others. It is health and safety risk, which related to the employee health and safety in the workplace. For example, they will have unsafe equipment or environment, and the workplace also will be stressed, which can lead to the potential for injury for repetitive strain, and they will have some employees that issue with a fall from height. It is property risk, which related to the security of both tangible and intangible. For example, in case of inventory protection against spoilage or thief, intellectual property right, potential of enforcement action, and lastly is reputational risk, which related to the perception of the organisation by its stakeholder, the media, and the general public, could impact the liquidity, capital, and credit rating. For example, publicity regarding production method, business practice, or internal control.
Assalamualaikum. I am Ainul Hamzan, 255829. I will present about market risk. Market risk is movement in the level of market price of currency, interest rate instrument, equities, or commodities may be causes an institution to suffer a financial loss. It can have a big impact on institutional financial health if the market price is weak. It is also known as price risk. There are two types of market risk, which are actual exposure risk and expected exposure risk. Actual exposure risk, they are forecasted with certainty and will happen, while expected exposure risk, they are forecasted but may or may not happen depending on certain outcomes. There are three actions can be taken, which are to provide full cover, do nothing, and to provide some cover. Advantage for full coverage is no more market exposure risk. For no coverage, ability to take advantage of favorable price movement, and for some coverage, enable an institution to maximize saving and profit. The action also have drawbacks. For full coverage, first, foregoing opportunity to gain. Second, if actual or expected cash flow do not materialize, it have to cancel each contract. Third, if cash flow do not equal the contracted amount, it have to unwind each contract. Last, if timing of cash flow do not coincide with hedge, it may have to resort to yearly payouts or extension of hedge contract. Next, drawbacks for no coverage. First, exposed to losses if market rate move against one position exposure. Cost of covering position can be expensive if volatility in the market increases, and exposed to potential non-event risk. Drawbacks for some coverage is same drawbacks with full cover and no-cover option. The big problem is which option to choose. First, full cover. This is the most conservative risk management approach. If option to be chosen, one have to decide which position exposure risk to cover, which hedging tool to use, and what cost. Second is partial cover, a good risk management approach, but need identify which exposure need to be hedged and those that not be hedged. Third is no cover. This is the most aggressive risk management approach. If this option chosen, it is essential one implements stop loss hurdle and take profit hurdle, has strategy to control exposure.
Okay, Assalamualaikum and a very good day to everyone. My name is Nur Shuhaida. Metric number is 264693. I will continue the presentation with the another risk in the treasury operation, which is liquidity risk. So what is liquidity risk? Liquidity risk management is a sub-function of treasury management. It's concerned with managing risk to liquidity and works hand in hand with the cash and liquidity management function to ensure that the business always has enough cash to meet its financial obligation. So liquidity risk can occur if the liquidity obtained from the asset or the liability side of the balance sheet is less than expected or liquidity needs are more than anticipated. So these are guesses that liquidity risk may result from credit market and operational risk. Impact on treasury. Liquidity risk should not be an issue of a business as usual. The case that funds can be replaced once they mature according to a sources from a top Europe bank. The key issue for bank is to make sure that they are fully prepared in situation where liquidity risk does become a problem. So the Treasury Group has many key responsibilities, one of which is to make sure that the most effective approach to cash and liquidity management are taken. During times of credit limitation, financial institutions need to be reassured that they have access to liquidity. For treasurer to fulfill their responsibilities and to achieve optimum cash flow management, they require rich information to parallel the organization cash flow cycle, global cash concentration, automated internal funding mechanism for deficit position, and investment option to match individual profile for liquidity, risk, and return. System control frameworks are absolute. Banks need to have a comprehensive and fully functioning framework to manage the risk. Banks are generally required to hold a minimal level of liquid asset, which may be used in the event of a liquidity crisis. Contingency funding plans have been drawn up to ensure that the alternative funding strategies are in place to meet any unexpected liquidity needs of the bank. Measuring liquidity risk. Almost every banking institution has its own methodology to measure the liquidity risk that they are exposed to. A number of techniques are available ranging from basic calculation to highly sophisticated modeling. It is important for banking institutions to adopt a technique that is more suitable and to take into consideration the nature, scale, and complexity of their activities. It has been found that some of the most common methods currently in use amongst the banks are gap analysis. This is the traditional method of managing liquidity risk and measure the difference or gap between the volume of interest earning asset and interest bearing liabilities represented over various time of period. The second one is target liquidity ratio. These are the basic bank financial ratio which measure firm ability to meet its short-term financial obligation on time. The third one is liquidity at risk. Some of the largest organizations are developing liquidity at risk models to complement to the more familiar value at risk techniques. This method is used for determining the value of the cash flow associated with the various on and off balance sheet asset and liabilities. Next, internal and external liquidity. The objective of liquidity risk management is to minimize the risk that the company will not have sufficient liquidity and credit line to meet its current or future financial obligation regardless of unexpected change in business and market condition. So liquidity can be generated internally or externally as the figure below shows. Each source of liquidity has its own risk, which need to be assessed and managed. So the internal of is releasing trapped cash, concentrating cash balance, releasing working capital. And for external is loan finance, factoring, bond financing, equity financing, asset and project finance, and trade finance. Next, managing the liquidity risk. The main risks to a company liquidity that need to be assessed and managed are intraday liquidity exposure, contingency risk from unexpected change in cash flow forecast, and the estimate of how much liquidity will be available from releasing trapped cash and working capital. Structure risk from mismatching of fund flow and position, fixed rate fluctuation and impact on payment flows and liquidity, risk inherent in each of the different types of funding, counterparty risk from the banks and financial institutions providing funding and investment. So the vital first step in managing liquidity risk is to have an accurate, up-to-date and complete assessment of how much liquidity the company has and the forecast position in the future. Then and only then can this be managed. In today's volatile financial and business markets, there is far more intraday position reporting and use of real-time system and service. General strategy as to how to minimize liquidity vary. Some companies concentrate all available liquidity centrally, while others use a regional concentration. On credit line, some companies ensure adequate local availability combined with the adequate availability of centrally committed credit lines that also include the maintenance of liquidity buffer, while other companies hold and manage all credit arrangement and lines centrally. Next, there are two basic types of liquidity risk, which is market liquidity risk and funding liquidity risk. What is market liquidity risk? Market liquidity risk is the risk that a position cannot be eliminated quickly by either liquidity, the treasury exposure, or by establishing an offsetting position due to the market disruption or lack of depth. What is funding liquidity risk? Funding liquidity risk is the risk that an institution will be unable to raise enough funds in order to meet its obligation on settlement dates or in the event of margin calls. So, funding liquidity risk play as an important role in the operation of bank.
Assalamualaikum warahmatullahi wabarakatuh, and very good morning to all my fellow friends and respected lecturers. I am Naamira binti Rusli, metric number 263949. For this part of presentation, I will present my part, which is legal risk. I will explain what is the legal risk. Secondly, I will explain how to mitigate legal risk. What are the examples or events that may subject to legal risk? And lastly, the evaluation of comparative risk in order to mitigate the risk to not be occur in the future. Okay, the definition of legal risk. Basel II Accord in 2003 has defined legal risk as component of operational risk, and it refers to risk on contracts that are unenforceable in court of law or any disputes that could take the institution to court for any action to be taken. In addition, it refers to risk of financial or reputation loss which is due from any kind of legal issue that hit the company, for instance. Next, I will move to second part, which is example of events that may be subject to legal risk. First, dealing with a currency that is forbidden. For example, dealing in Malaysian ringgit currency, but not in local country, which is Malaysia. So the case cannot be enforceable in court in Malaysia. Secondly, the contract has been signed and confirmed, but through a person that is not properly been authorized. Thirdly, dealing with a counterparty that has been approved. However, the counterparty has already declared as insolvent person. Last but not least, involved in foreign exchange transaction with approved counterparty, but the person represented the counterparty is not properly being authorized. Each risk has their own mitigation, and these are the examples, the steps on how to mitigate legal risk. Legal risk management framework. There are 4 steps. First is step 1, we need to identify. Then we need to understand the risk that universe. This is very crucial so that we can identify the legal risks that may cause negative impacts toward our organizations. Therefore, we need to define clearly what constitutes legal risk, so entire company can easily understand more about it and be aware about it. Second step is we need to assess the risk. We need to define and embed a risk assessment process in order to assess the level of legal risk exposure towards our company. Some agreed set of factors that can be used, such as regulatory, customer, financial, and reputation implications. And we need to set risk appetite if we want to focus on legal risk areas. The third step is control. We need to determine the level of investment in control, so that we need to control some measures which include policy settings, procedures, guidelines, and self-service tools. Include also training for escalation to legal, provision of legal advice, issue management, and use of technology to drive control. The first step is we need to monitor and report. To assess the efficiency of control environment, such as key control indicators, control testing, we need to design a methodology. And of course, we need to report residual risk profile for legal and control effectiveness to relevant governance forums.
Last about evaluation of cooperative risk. This defined as the systematic evaluation of the changes in population health which result from modifying the population distribution of individual or group risk factors.
I will explain about the example of comparative risk assessment. First, in industrial countries. In the United States, it has been used to set overall environmental priorities for the nation, to guide legislation, and to choose among regulatory approach. It has been used, for example, to decide which air pollutants to control, which pesticide to allow and which to ban, and to what degree contaminated hazardous waste sites should be cleaned up. Then, in developing countries and transition economies, comparative risk assessment can help regions and countries allocate limited resource efficiently. For example, the method has been applied on a citywide basis in Bangkok and in Cairo to identify specific recommendations for targeted action such as reducing lead in gasoline and managing traffic situations to decrease levels of particulate matter. Also, a study have identified a consistent set of priority problems such as particulate air pollution and microbiological disease caused by water and food contamination. These problems are likely to be of high concern in any rapidly developing area that lacks adequate municipal infrastructure and is experiencing a rise in industrial activity and traffic volume. So, comparative risk assessment performed in such setting may direct resources to examining this problem first.
Okay, I will continue the presentation with the step of risk assessments. The first one is identify the hazard. The competent person must look at the process, each product, tool and machine used and the environment being worked in. Then identify anything which may cause harm to people or property. They should also consider the chargeable factors such as weather, training, supervision, lighting, temperature and so on. The second one is decide who may be harmed and how. So the competent person must be analysed each of the identified hazard and decide who they may apply to. Consider members of the workforce, people carrying out the task, bystander, and even specific groups of the people such as pregnant mothers. So this should create a clear picture of who may be harmed and how. So step 3 is assess the risk and control them. Once the risks are known, they must be scored by how likely to occur they are and potential however. A simple 5x5 risk metric is used to assist with this process. For risks that pose a significant threat, a control must be arranged. For example, if the risk is an icy path, the control would be to use a grid. Some risks may have such a small likelihood that the control is simplified, ensuring that those affected are aware of the risk, allow them to operate mindfully, whilst other risks require more formal controls to be arranged. The step 4 is recording the findings. Once the competent person has completed step 1 to 3, they should record their finding into a task-specific risk assessment and store this document for reference. The risk assessment should have been seen by every member of staff who might be involved with any part of the task, and their understanding and acknowledgement of this document should be recorded and kept up to date. The last step is completing the reviews. Every risk assessment should have a sensible review period. While many companies review risk assessment annually, some risk assessment or tests are so specific that they require a new risk assessment to be produced each time the task is undertaken. The task will also need to be reviewed every time sometimes change. For example, training, tools, PPE, process or the environment the task is carried out. Okay, that's all for me. Thank you.
Okay, now we'll talk about 5 basic methods for risk management. So first is avoidance, which is the method for mitigating risk by not participating in the activity that could harm them. So in case of the health, smoking is actually a good example, since by avoiding this, it can actually lessen both health and the financial risk of the individual. And second is retention. So it's actually the acknowledgement and acceptance of a risk as a given. So however, it is for the certain risk. So in term of the healthcare, it could mean that picking a less experienced health insurance plan that has a higher deductible rate.
Next, for basic method for risk management is sharing. Sharing risk is often implemented through employer-based benefit that allow the company to pay a portion of insurance premium with the employee. The understanding is that with more participants sharing the risk, the cost and payment should split proportionally. Individuals may find it in their best interest to participate in sharing the risk by choosing employer, healthcare, and life insurance plans when possible.
Next, I move to second part, which is evaluation of comparative risk. There are 5 steps how to evaluate the risk, but I will explain only 2, which is transferring the risk to other party. What is risk transfer? Risk transfer means we need to transfer the risk from one party, which is our company, to other third party, for example, insurance company. The transfer will take most of risk and liabilities will be borne by the insurer. Whom to transfer to? Usually, insurance company will exchange fee known as premium for financial risk that has been transferred to them. And the contract involves documented contract between insurer and individual. What contains in the contract? The contract mentions stipulation and conditions that need to take account by insurer in order to accomplishing the financial responsibility that has been given to them. We move to the last step, which is loss prevention and loss reduction. It's applied to minimize the loss but not completely eliminate it. We need to keep the loss contained and preventing risk from spreading. On the other hand, in order to manage loss reduction, the company should review and update insurance, and also they will need to create or modify the policies for internal control and thus implement procedures for standard operating. There are some steps that can be taken, such as they can ask opinion from the government and local agencies that will create and plan implement strategies that can be used to manage loss reduction management, because they will provide useful advice and assistance on how to prevent, control, and reduce excessive losses towards our organization. That's all from me. Thank you.